Okay, welcome back. I mean, what's happened is that the market now has broken below below yesterday's low. Yesterday's low was 17,064. It was a pretty large candle yesterday from the low to the high. The low was 1764. The high was, 17,280. And today, it's a bigger bar, by the way, and it's still developing with 30 minutes to go, 35 minutes to go. We've broken below that low yesterday. 1737, 1740 on the Nifty now. It's a full 200-point cut here on the Nifty. And this has happened a bunch of times that, US markets, it could be CPI, it could be other news-related, data-related, impact which comes through. The market here immediately the day after does nothing. The day after, the real impact starts to come through. I remember, I think the last Fed meeting or maybe the one before that, we had a similar kind of reaction. Absolutely fantastic outperformance. Immediately, the day following a big crack in US. And then the next day, you get a proper sell-off. So this seems to be one of those. 17,030 is where we are at. Jay Bala of CashTheChaos.com is with us, as always, Tuesday afternoons. Jay, good to have you with us here. Thank you very much. How are you? So what are your levels and what's the near term and medium term picture looking like to your mind?
Yeah, thanks for having me on the show, Prashant. You see, I've been saying that this market had turned to a sell-on rise mode, and there's no change in that. But the important implication for the market would be when it breaks 16,855. We always consider markets from a probabilities perspective. So, although the greater probability, in my opinion, has been the markets are going down, the residual probability that market is bullish will get completely eliminated when the markets break 1685. Intraday break don't even need a close. So, so that's the important level for the bullish case to watch out for. The resistance for the market is about 17,430 and 17,700. From a medium-term perspective, this market is, I've been saying, even if the markets were to make record highs, it'll actually be counterintuitively bearish, and it'll be worse than the 14,000 that I've been projecting. So, right now, if and when 16,855 gets broken, the focus will be back to the June lows.
Okay, so it'll be worse than the 14,000 that you're projecting on the Nifty. I mean, are you expecting much more downside from here on? If yes, Jay, what are the kind of stocks that you're looking at? Because clearly, IT has been leading it from the front on the downside. Do you think banks will also start to participate now? And how do you approach it then?
Yeah, number of questions there, Sonia. See, banks are a shade weaker than the Nifty. The trend, the downtrend to me is clearer on the banking index rather than on the Nifty index. So, watch out for HDFC Bank. If that were to break 1365, it'll be very, very negative for the sector. And the supports, around 37,300. That'll get taken out on the Nifty Bank futures. So watch out for it. That's going to be pretty important for the sector. And IT, I've been painting, a medium-term bullish picture for it, but it just needs one more lower low below 26,100. If it does that and holds 24,400, that'll be bullish. But so basically, in the short term, some downsides need to be worked out. The sector that you said, that might, point to weakness is actually the auto sector. It's sitting on an important trend line. It's at 12,500 now, just 100 points away from an important trend line. Already it's showing signals that it's turned, but if 12,400 were to go on a closing basis, the leading sector is turning down. So watch out for it. 12,400, the auto index is very important.
Any particular stocks in the auto pack which you're watching or someone can trade today listening to you?
See, Tata Motors is the relative underperformer within the sector. It didn't make a fresh high when the rest of the pack was making highs. So that's an important stock that if you want to be bearish on. And also, you have to wait a little bit. If Maruti were to break 8,500 and M&M were to break 1,200, these are the leaders. Profit booking might come in. So that might be another trading opportunity within the sector.
Mm. Jay, what are the chances? Lawrence Belanco of CLSA put out a note yesterday saying that it's possible that in the last quarter, October to December, we have a 10-15% rally in US markets. And he pointed out to a couple of divergences which happened in June as well. One of them was that the US Treasury note made a low 2 days before stock markets bottomed out in June earlier this year. He says that it's happened again. The US Treasury made a low on the 27th of September. Second, he points out the Russell has not confirmed a low with this, along with the S&P and a couple of other divergences. What are the chances to your mind?
Yeah, I would rate it very low. I think it's the other way. Yesterday we had the FANG Plus index, which I pointed out several months ago. I had pointed out, make sure that it doesn't cross 6,100, it will be bearish. It actually went only up to 5,800, and yesterday it actually broke below the 2022 low. And once again, the Russell 2000 that's the only index that's not made a new 2022 low. But in fact, the cycle for the Russell is quite different from the cycle for the rest of the stocks. The Dow Transport, Dow Industrials, Nasdaq, they are all making new lows, and the S&P is just marginally just away from the 2022 low. I would put it the other way. If there's a template of the 2008 and the 2022, the markets, tracing out a very similar path. If it follows that, continues to follow that path, we might have a washout low coming in around October 25th. So markets don't behave, in such a fashion, but watch out for it. That might be a capitulation, pretty similar to what happened in 2008. But, this is a probabilistic scenario.
Okay.
But, 3571 on Nifty, S&P futures were to break, I think there is an acceleration very much possible there.
Okay, I mean, actually, a point taken. You're saying you're rating the chances of a meaningful bounce pullback in U.S. equities is very, very low, and you're looking at this the other way. By the way, this 2008 Lawrence in his note does say that the only risk to this is if there is a liquidity event of some sort. Then you're looking at what happened in 2008, because 2008 was precipitated by Lehman, right? That's not, of course, that was not the base case back then, but now presumably things are better, or maybe they're not. But again, no one is really expecting that. But he does put in that. That's the risk. That's the outlier. Then, of course, all bets are off. Go on. Finish that point, Jay, briefly.
Yeah, see, again, if you look at the treasuries, their treasuries or the dollar index, the momentum is very strongly with them. And the momentum is pointing to higher yields and higher dollar index. I'm working with 117 for the dollar index, with or without a print of 109.29 on the dollar index spot. So, so the short term and the medium term and the long term for the treasuries and the dollar index is pointing upwards. So, that's a very, very significant change from 2008. And it's the recent market correlation with the treasury, 10-year treasury yields and the dollar index has been pretty important for the markets, at least in the short term. So, I'm expecting both to travel higher. In the near term, I'm working with about 430 for the US 10-year yields and about 117 for the dollar index spot.
Okay, well, you know what? The market is getting spooked by what you're saying. The Nifty